You're watching Morning Markets. I'm John Ehrlichman. Lots of earnings that we have been tracking this morning, including from the retailer Sleep Country, out with their quarterly results. And as we've been talking about all morning, one theme right now is what consumer habits are like. Here to talk a little bit more about what's happening at Sleep Country is the company's CEO, Stewart Schaefer. Stewart, thanks as always for joining us. Nice to have you back.
Good morning, John. Thanks for having us back.
So I guess you got a lot of analyst questions just trying to take the temperature of the consumer right now. You don't play the role of economist, but you are operating a company that has to watch the consumer trends. What are you seeing in the business right now?
I guess it's a continuation of what we've seen over the last 3 quarters. The consumer seems healthy, but like your previous guest just said, uncertainty is out there. Nobody likes uncertainty. And I think especially within our area of business, consumers waiting for mortgage rates to hopefully come down a little bit to activate the housing market. And that has been over our heads for a period of time. And I think on a discretionary spend, consumers are pausing a little bit to see what's going on.
And on the subject of when people move, like literally move homes, I guess the interest rate story factors into that. In terms of purchasing of things like mattresses, how much of that is dependent on the idea of someone moving from one home to another?
Great question. Consumer confidence is everything. So value of the home is one component, which seems to be somewhat stable. But moving is another trigger, because when you're moving, you're lifting up your sheets and you're looking at your mattress and you see that it's 8 to 12 years old. And when the consumers are not, when Canadians are not looking to move because they don't want to go from a 2.5% mortgage to a 6.5% mortgage, it puts a pause on the entire industry. Doesn't go away, it just puts a pause on it.
And so in this environment, how are you operating the business? What's the approach for Sleep Country?
So in Q1, we were actually up 1.6% in revenue, which in the industry right now, that is pretty stellar. But it came at a cost. It came at a cost of more marketing costs to drive the customers into the doors. It came a little bit more promotional, even though our GP margin held relatively well. It was definitely a more of a promotional period just to try to get people to go out and purchase.
Actually, on the subject of, and look, Sleep Country has numerous brands, numerous ways to purchase mattresses. You can do it online. You can do it in different stores that you operate. Renovations to stores is something that you guys also do. What have you been working on? What do you find is working in terms of getting people into the stores and interested in your product?
Well, besides the Sleep Country network that we continue to grow and is over 300 stores now, and that's still the plan. In the last quarter, in the fourth quarter, and again in this quarter, we're testing some new brands, standalone stores. Our D2C brands are being brought into a tactile environment, Casper, ND, and Silk and Snow. And customers are loving the experience. And so that seems to be driving a new customer segmentation that maybe love the brand, but maybe potentially needed to kick the tires a little bit before they made the purchase. Also, in Yorkdale Mall, we're testing another new store, a high-end concept called The Rest, which is a collection of unbelievably handmade mattresses with horsehair and Jamala wool, and that's a whole other area. So we're broadening our customer segmentation and trying to find ways to engage with our customers more than ever.
I guess that speaks to the fact that the business has definitely evolved. You're now into your 30th year as well, and you always got to be adding and innovating. You talked a little bit on the call as well. I mean, analysts are always curious about how capital will be allocated. You know, is it good to invest in the existing business? Should you consider more acquisitions, which Sleep Country has never really shied away from? Do you want to use some of that capital for shareholder-friendly things? How are you thinking about it going forward?
Number one thought is always around our total shareholder return. And we've been fortunate enough in terms of the way that we manage our balance sheet and the success of our business from our loyal customers that we really try to do it all. I mean, last year was a record year for us in terms of buying back our stock. We still pay a very healthy dividend. As you said, renovating stores to make sure the experience is better. But investing in growth has always been a big part of our thinking, and we have actually more opportunities of growth today than we did, say, 3-4 years ago. So whatever investment we make, we look at it very closely, we test a lot of different things and see which one is giving the maximum shareholder return.
And on the cash flow front, do you feel good about what you're generating right now and the flexibility that will provide you on those various options?
Our cash flow has always been really strong, especially with our model, our business model that we have. I don't love higher interest rates because that's always a little bit of impact in terms of cash flow. But yes, I think we like to build up our war chest, as we call it. And cash is very important. We don't like to be over leveraged. We never know when another opportunity may present itself, whether it's doubling down on an investment in our existing business or something that comes along in terms of M&A. So we like to sleep well at night at Sleep Country, and having a strong balance sheet makes us sleep very well.
And since you mentioned interest rates, how are you preparing for the road ahead? I mean, like, we sit here every day. We don't know when interest rate policy is going to change. We don't know ultimately where the economy will land. So how do you prepare for whatever happens next?
Well, the first thing we do, John, is watch your show every day because we're waiting for you to announce that the Bank of Canada has cut rates. We're careful with our money. So normally we do about 20-30 renovations of stores, and we pulled back on that. And our focus over the last year and a half, because of the cost of money is no longer free, that we have to really focus on how we're getting the best bang for our buck. And so we'll pull back on renovations and maybe invest in growth. We'll look at our existing business on how we could drive efficiencies. And a big part of that is bringing all the acquisitions that we've done over the last few years and bringing them into our logistics network. And we try to build up that gunpowder and service our customers and wait for things to turn. But we definitely, on the investment side, on our capital, will pull back on our renovations during this time.